Target Corp, TGT, is currently sitting at $99.55 USD, having seen a strong upward move of $3.02 or about 3.13% during the most recent trading session. It is worth noting that since today is Saturday, December 27, 2025, the market is currently closed. This closing figure reflects a significant late-week rally that has many analysts shifting their stance on the retail giant after what has been a punishing year for the company. While the broader market indices like the S&P 500 have been hovering near all-time highs, Target has spent most of the year in the bargain bin, but this recent tick upward might be the first real signal of a structural shift in how institutions are viewing the stock's intrinsic value relative to its peers. The common belief among retail traders right now is that Target is simply a slower, more expensive version of Walmart that lacks the grocery-driven foot traffic to survive a high-inflation environment. Most people look at the chart and see a brand struggling to find its footing after the post-pandemic shopping spree cooled off. But the reality that just hit the tape suggests something far more interesting is happening behind the scenes. We just learned that an activist investor, Tom's Capital Investment Management, has taken a notable stake in the company. This is the classic signal that the smart capital in the room thinks the management has left too much value on the table. When an activist enters the picture, they aren't just looking for a quick 5% gain. They are looking to shake up the board, prune underperforming categories, and perhaps even push for a more aggressive return of capital through buybacks or dividends. This unexpected development has created a massive curiosity loop because it forces us to ask, what does a sophisticated hedge fund see in these numbers that the general public is missing? If you look at the recent movement on your Fidelity mobile app or through the Interactive Brokers platform, you'll notice that the volume on this Friday move was significantly higher than the 30-day average. That usually means it wasn't just retail speculators jumping in, it was institutional desks rebalancing their portfolios. We've seen a lot of capital flowing out of overextended tech names lately. While Nvidia stock has been the darling of the market for a long time, the massive licensing deal they just signed with Grok has some investors wondering if the peak of the hardware cycle is near. When people start taking profits on Nvidia stock, Tesla stock, or Apple stock, that capital has to go somewhere. Right now, it looks like a portion of that wealth is rotating back into beaten-down value plays in the consumer discretionary sector, and Target is the prime candidate for that rotation. The tension here lies in the gap between what Target is reporting and what the market expects for 2026. The recent third-quarter report showed a slight decline in comparable sales, which usually would be enough to send a stock into a tailspin. However, the market reacted with a shrug followed by a rally. Why? Because the bad news was already priced in. When a stock is trading at a forward price-to-earnings ratio that is a fraction of its historical average, the bar for a beat becomes incredibly low. For those using Schwab Intelligent Portfolios or a SoFi robo-advisor, you might have noticed your automated allocations shifting slightly toward these value-heavy consumer names. The expectation was that Target would continue to bleed market share to Amazon and Walmart, but the reality is that their digital ecosystem is actually growing. Their digital comparable sales grew by over 2% recently, and their same-day delivery services through Target Circle 360 are seeing growth rates exceeding 35%. This suggests that the Target customer isn't leaving, they are just changing how they shop. Let's talk about the institutional activity for a second. If you use Interactive Brokers trading tools to track block trades, you would have seen a series of large buys occurring near the $85 level throughout November. That formed a solid floor. Now that we are pushing toward $100, we are entering a zone where technical resistance used to be support. The move to $99.55 USD is a psychological breakthrough. If the stock can hold above this level when the opening bell rings on Monday, it could trigger a series of buy signals for momentum algorithms. This is why having a robust Fidelity trading platform or an Interactive Brokers account is useful, because you can see these subtle shifts in momentum momentum real-time. Many investors who engage in self-investing often miss these subtle shifts in momentum because they focus too much on the headline earnings per share and not enough on where the big funds are parking their assets. In the broader context of online investing, the retail sector is currently a battleground of conflicting data. On one hand, you have the higher for longer interest rate narrative that has pressured consumer spending. On the other, the labor market remains relatively tight and people are still spending, albeit more selectively. This is where the Target business model is being tested. Unlike Walmart, which is almost 50% grocery, Target relies heavily on discretionary items like apparel, home decor, and electronics. These are the first things people cut when their budgets get tight. However, the company is responding by slashing prices on thousands of essentials. They are trying to lure the value-conscious shopper who still wants the Target experience but doesn't want to pay the Target premium. If they can successfully transition from a treat-yourself destination to a daily essentials destination, the upside could be significant. For those of you looking for investment help or scanning through various investing sites, it is important to understand the role of margins in this story. Target's operating margins took a hit recently due to markdowns and some one-time restructuring costs. They actually eliminated about 1,800 roles recently to lean out the organization. That is a move straight out of the big tech playbook. We saw Apple stock and Tesla stock benefit from similar efficiency drives in the past. If Target can get its operating margin back above 5 or 6%, the earnings leverage would be massive. This is the kind of detail that professional Fidelity wealth management advisors look for when they are building out long-term positions for clients. They aren't looking at what happened last month, they are looking at what the margin profile looks like 2 years from now. Comment below how many shares of Target you currently hold or if you are planning to add to your position at these levels. I'm curious to see if the sentiment among our community is as bullish as the recent activist move suggests. When we look at the older reports and the historical performance, it's clear that Target has been here before. They had a rough patch around 2017 and 2018 when people thought Amazon would kill them. They responded by turning their stores into fulfillment hubs. That was a masterstroke that saved the company. Now they are trying to do it again with artificial intelligence. They are using something called Target Trend Brain to predict what people want before they even know they want it. They are also partnering with OpenAI to integrate ChatGPT-style assistants into their shopping app. While some might see this as a gimmick, if it reduces friction in the digital shopping experience, it could be the catalyst that stabilizes their market share. If you are using the Robinhood app for Robinhood stock trading, you know how much a smooth user interface matters for engagement. Target is trying to bring that same level of digital polish to the physical retail world. Now let's consider the risks, because no analysis is complete without looking at what could go wrong. The elephant in the room is the potential for new tariffs. Target imports a significant amount of its discretionary goods from overseas. If trade tensions escalate in early 2026, those costs will either have to be passed on to the consumer, which could hurt demand, or absorbed by Target, which would crush margins. This is why some people prefer Fidelity ETFs or Fidelity mutual funds that provide broader exposure to the retail sector rather than betting on a single name like TGT. Diversification through an individual brokerage account or an intelligent portfolio can mitigate the risk of a single company getting hit by specific trade policies. Furthermore, the competition is not standing still. Walmart has been a juggernaut lately, and even companies like SoFi are expanding their reach into how people manage their wealth and spending. If you use SoFi Invest or the SoFi trading platform, you've seen how these fintech companies are creating ecosystems that keep consumers locked in. Target is trying to build its own ecosystem through the Target Circle 360 program and their Fidelity IRAs and credit card partnerships, but they are playing catch-up in a very crowded field. For those who invest online, the choice often comes down to who has the better data and the better relationship with the customer. Looking ahead to 2026, the catalysts are clear. We have the activist investor presence, which will likely keep management on a tight leash. We have the aggressive $5 billion capital expenditure plan to remodel stores and build out more fulfillment capacity. And we have a valuation that is still very attractive if you believe in a soft landing for the economy. The expectation is that the retail turnaround will be a slow, painful crawl. The reality might be that the floor is already in, and we're just waiting for the macro environment to catch up to the micro improvements Target has already made. For the self-directed investor, using Robinhood investments or interactive brokers' fees as a metric for where to trade, the takeaway here is one of calculated patience. Target isn't a high-flying tech stock like Nvidia stock, but it also isn't a dying mall brand. It's a massive cash-generating machine that is currently being forced to reinvent itself. The fact that it closed at $99.55, up over 3% in a single day, shows that the market is